Pursuant to Internal Revenue Service guidance, be advised that any federal tax advice contained in this program is not intended to be used, and it cannot be used by any person or entity for the purpose of avoiding any tax penalties that may be imposed by the Internal Revenue Service or any other U.S. federal taxing authority or agency, or promoting, marketing, or recommending to another party any transaction or matter addressed in this show. The opinions expressed by the host and the guests are their own and may not be used as authoritative advice. Any use of this material without the written consent of the host is strictly prohibited.
Welcome back. I am your host, Attorney Steven A Leahy, and we are sponsored by Opum Tax Resolution.
God bless you, Opum Tax Resolution.
And the law office of Steven A Leahy, PC. And if you have any IRS problems, you should call them at 312-664-6649.
Well, this is the section that we talk about your blog entry.
It is.
And what is the entry this week, Steve?
Well, this week I write about the mortgage complexity, how complex it is, different than it used to. Now, last week we talked about the Illinois mortgage foreclosure law and how one way is to go about trying to buy time or fight it, and one way was litigation. So there's some lawyers out there, I think they talk about the fire and brimstone, and they want to cast these. We got to go out there and fight them. We got to kill them. It's just the most evil thing in the world, and there's some truth to that. But in the end, I think litigation is one way to buy yourself some time and try to get a loan modification or try to save your home that way. But there's other ways to do it. And I started talking about last week when we talked about discovery. So you go in, you get a foreclosure defense, and you try to do some discovery. And one of the reasons why this tactic works is because residential loans have become so complex that these mortgage servicing companies lose a lot of the paperwork. And this goes back to these robo-signing things and all these scandals that you've heard about. So it used to be I went to my bank years ago. I wanted to buy a house. So I went to my bank, and my bank did an investigation, and they looked at it.
No way.
And they looked at everything, all my income and all my assets, and they made a determination. Okay, let's loan this family some money so they can buy a house. And they loaned you the money, and then every month you repaid that loan to that same bank, and at the end you were finished, and that was it. But things aren't like that anymore. And now there's a secondary mortgage market, and the market makes it very complex. So nowadays, what generally happens is you go to a mortgage broker, and the broker finds a mortgage originator, and the mortgage originator writes a loan for you, and then almost immediately upon entering into the agreement with you, they sell it to somebody else. And these are generally called mortgage aggregators. And so this aggregator, what they do is they buy loans. They make some loans themselves, and they buy loans from others, and they bundle them all into a they call it a pool or a package. And they sell these packages now to either to Wall Street or to some quasi-governmental
Fannie and Freddie.
That's right. Fannie Mae and Freddie Mac. And we all heard about that, but we don't know.
That's what caused the whole problem that we're in.
Well, I think it is part of the problem in that they, the people who are originating the loans really don't care if you have the ability to repay it, because they're going to get paid whether you can repay it or not. They're getting their end up front, because their job is to originate the loan. So they originate, and this is part of the problem with a lot of these lenders that are now out of business. What they were doing is going out and just giving loans to anybody, and none of these loans really had any backup, so they were all false.
Of course, a lot of that came from government fiat and telling them if you don't loan to people, that
that's true, and they had some goals in mind so they would overlook your finances. Again, whether you had the ability to repay it or not, it didn't really matter to them. It was a fact that you needed the loan, and they gave you the loan, and they got paid. And again, then they would give it to these aggregators, and these aggregators would turn around and they bundle them, and they'd sell them to Fannie Mae, Freddie Mac, or some Wall Street firms like Goldman Sachs, and that's why they went under. And then there was insurance companies like AGI who insured a lot of these pools, and then they take these pools and they once they bundle them, then they put them into a trust account. Okay, so now there's a trust company involved, and so now technically the trust owns these loans, but they really don't own any legal or beneficial interest. They're just a title holder. So then the loan, and then these aggregators also have to hire servicing companies. So now these servicing companies are the ones are the people that you talk to when you have a loan. So if I have a problem, I have a question about my loan, I call my servicing company. They don't own the loan. A servicing company is a lot like a property manager, in that if I rent a house and I have a problem with my apartment, I call the property manager, and the property manager sends somebody out to fix something. If I have a plumbing problem, if I have a question about my rent, I call the property manager. When I write my check every month, I send it to the property manager. But the property manager doesn't own the property, right? They just manage it. So they just take the money and then they give it to the owner. Well, the same thing here with the servicing company. A servicing company doesn't own the loan. They simply manage it for somebody else. And so a lot of people get confused about who owns the loan. So if in fact I ever go into foreclosure, so I've seen cases where the plaintiff is the trust company. So they'll U.S. Bank trust number XYZ 123, and they'll list this trust number.
Somebody changed the combination of my luggage.
And sometimes I see it that it's the originator, and they're named as the plaintiff on the case. Now, again, generally the originator has already transferred that loan to somebody else, so the originator doesn't own the loan anymore. So they're not the proper party. And then sometimes you'll see that the plaintiff is the loan servicing company, and so they're bringing the case. So a lot of times, I think most often, that when people are served with the foreclosure case, they don't even recognize the plaintiff who's in charge. Okay, so if I'm trying to resolve this matter, and I'm a homeowner and I'm behind in my mortgage and I'm trying to resolve this matter, and I try to do a loan modification, and this is what most people do because we keep hearing about it on the news. So they'll call the servicing company and say, "Hey, I want to work out some sort of mortgage modification," and then the mortgage servicing company will say, "Well, okay, well, send us," and then they'll give you a litany of things that they want from you, tax records and bank statements and payroll tax records and payroll records. All of this, they want to know. They're going to do an investigation. Well, this investigation generally takes many, 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 many months. And I've seen some that don't, but most often it takes 6 months or longer. If I'm in foreclosure and they've served me a foreclosure summons, and then I contact my servicing company, and then I try to do a loan modification. By the time I get a loan modification, they could already have a judgment against me and a sale date on my house. And so the best thing to do if you get served a summons is get some help. You need to delay that date of when there's a date of judgment, because the law here in Illinois is the Illinois mortgage foreclosure law allows the owner of that loan to sell your property 7 months from the date that you get served, or 3 months from the date of judgment. So the goal here in the strategy is to push that date of judgment out as far as you can. And sometimes so many of my cases are 3-4 years old. Now that's I don't think that's typical, but that's how it happens. And in the meantime, while you're kicking that date out and you're fighting the foreclosure case, then you can work on this loan modification. And maybe if you get denied, then you can try again. And most people, I think, have to try more than one time to get a loan modification. And I think next week or the week after, my blog post is going to be about loan modifications and how those work. So stay tuned, because we're going to talk about that.
I'm all tingly. Let's prepare for that one.
I'm going to tell you something. If you're looking for a loan modification and you're trying to save your home, you certainly want to find out how to do that.
Well, which is why you need an attorney.
I think you do need an, and you need a good strategy.
You never go into court without an attorney.
That's right, and I think you need it. But this is important. You want to save your home. You need a strategy. You need someone who has been down this road and can tell you. I always tell people that there's ways you can look it up, and you can go on the internet and try to find out how it all works. And I always tell people there's ways that it's supposed to work, and then there's ways that it actually does work. And the only way you know how it actually does work is by going to court all the time and seeing how it works. And so if you're in foreclosure and you're having a problem with your bills, then you need to call me at 312-664-6649. You can visit us on the web at chicagotexteam.com.
You need somebody to advocate for you. That's you right. Need somebody on your side.
That's right. Send me a question at questions@irsradiohour.com.
Don't go anywhere. We'll be right back.